I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. Hi, good to see you today. Right, let's go straight to today's topic. All right, so we've been on group balance sheet, that's consolidated balance sheet. Okay, here we have a parent company and its subsidiaries. Okay, so today we are looking at we call this looking at of course it's still balance sheet, but today we are looking at current accounts within your group. Okay, so of course sometimes you can hear or you can come across the word intra-group current account. So basically, if you're using current account within the group or you're using intra-group current accounts, you're saying the same thing. Okay, so what we're talking about here is simple. Okay, you have transactions between the parent company and the subsidiary. Okay, so what we're saying here is that so long as there's a transaction between the parent company and the subsidiary from time to time, in capturing this transaction, usually there's this relationship between the subsidiary and the parent company that comes in form of one being a debtor and the other being a creditor. Okay, so depending on how the transaction flows between the holding company, okay, and the subsidiary, one can be a debtor and then the other a creditor. So at every point in time, depending on the transaction flow, okay, transaction flow as at the time of reporting, depending on that you can have the holding company being captured in the book of the subsidiary as a debtor. Then the subsidiary is being captured in the book of the holding company as what? As a creditor. So at every point in time, the holding company has an account capturing transactions between itself and the subsidiary. The subsidiary also have an account capturing transactions between itself and the holding company. So at the end of the period, or as at the time of reporting, each has a particular balance. So it's possible that based on the transaction between the holding company and the subsidiary, the account that the holding company is holding against the subsidiary is having a debit balance. So it means that in the book of the subsidiary, the account that the subsidiary is holding against its holding company will have what? A credit balance. So usually, the account that we use to hold this transaction is called the current account. So what I'm saying is that at every point in time, let's say we have A Limited, which is the holding company. Then we have B Limited, which is the subsidiary. So long as there are transactions going on between A Limited and B Limited, A Limited has an account it's holding against B Limited called current account B Limited. B Limited has an account is holding against A Limited called current account A Limited. So in the book of B Limited, you will see current account A Limited. In the book of A Limited, you see current account B Limited. So what this means is that as they're having transactions against each other, if holding company is debiting the subsidiary would what? Crediting the holding company. If holding company is crediting the subsidiary would what? Debiting the what? Holding company. So it means that you're going to have, each of them taking their what? Their steps in the transaction what? Flow. So at the end of the reporting period, we expect that, if the holding company is having a debit balance of 20 naira against the subsidiary will be having a credit balance of 20 naira against the what? Holding company. So what I'm saying is this: at the end of the period, if A Limited has what? A current account debit what? Balance against B Limited, B Limited will have a current account credit balance against A Limited. Do you understand? So at every point in time, if A holds B as a debtor, B will hold what? A as what? A creditor. So here, if it is 20, it is meant to be 20 here. So it's like saying plus 20 minus 20. So at the point of consolidation, we expect that this 20 should cancel out this what? 20. So where you now have an issue such that this guy is having 20, but this guy is having, let's say, 18. So that means a difference. There's a difference. So for you to consolidate, both must be equal. So you must understand the difference. What is the cause of the what? Difference. Okay, so once you identify the cause of the difference, you now raise your appropriate journal to what? Nil out the what? Difference. Now remember, B has a debtor. A holds B as a debtor, 20. Now B is holding A as a creditor, 20. But we expect, that means that in B's book, current account, which is what? Against A, is appearing like this. Balance brought forward, 18. But we are expecting that this should be what? 20, not 18. So it means that before we consolidate, we must ensure that this becomes what? 20. So if we are raising a journal, we have to now what? Credit what? Current account, which is against A Limited, with 2 naira, which is difference, and then we now debit whatever reason that is causing that what? Difference. Is it that the holding company has sent some items to what? The subsidiary, that the subsidiary is here to receive as at the point of what? Consolidation. Because they are likely not going to what? Capture the transaction against themselves if they've not received the what? Product. So let's say goods in transit. So that means the product that has been sent from A Limited, which is the holding company, is yet to arrive at what? B Limited. So B Limited is yet to receive the product. So even though A has sent it and has confirmed that it has left, and they have debited it against B in their book, B is here to receive it. So B is here to what? Credit it against A in their own book. But at the point of consolidation, we have identified that there's a 2 naira difference, which is goods in transit. So now we want to make sure that this 18 agrees with this 20. So now we're crediting the current account A Limited with 2 naira. We are now going to debit what? Goods in what? Transit with what? 2 naira. So by the time we do that, we're going to have goods in transit here, 2 naira. So we now open goods in transit account, right? Which is what? Current account, 2 naira. So that means this will now be what? 20, right? So it means this 20 now can cancel that this 20, but we now have what? Goods in transit, which would be what? An asset, remember. That will give balance. Remember your assets, debit, liabilities, credit, expenses, debit, income, credit. Now we have goods in transit that will appear in your what? Asset side. Thereby allowing what? The current account against A limited, which is 20 naira, to cancel that against B, which is also what? 20 naira. Now remember, this is goods. Don't forget, you have to also identify if these goods has been transferred from A limited to B limited at cost plus any profit. So if there's a profit element in these goods in transit, you must now adjust for what? Unrealized profit on what? Goods in what? Transit. So that's it. But I already taught you how to adjust for unrealized profit on inventory or stock item. So it's practically the same thing. So long as you are able to adjust for the difference between the current account with the holding company and the current account with the subsidiary, and then you are able to identify that what the product is in transit. Then you also identify that maybe it was transferred from the holding company to the subsidiary at a cost plus a particular margin. You have to adjust for the unrealized profit and then raise your necessary journal. I believe you already know how to adjust for unrealized profit on stock or inventory. It's practically the same thing. So if you have not taken that class, why take that class and understand exactly what we're talking about. So here, what I've simply explained to you today is the use of current account within the group. So what I'm saying is that the holding company usually would hold a current account against the subsidiary. The subsidiary will hold a current account against the holding company. So transactions between them are posted into this current account against each other. So at the end of the period, or at the end of the reporting period, when the holding company has a debit balance against the subsidiary will have a credit balance against the holding company. So it goes like that. So if the holding company is having credit against the subsidiary, we have a debit against the holding. So when you're consolidating, it will net off. But I'm saying that it is possible to have a difference. So that difference, we must identify the reason for the difference and raise the necessary journal to adjust it. So the current account will cancel out each other. So whatever it is, that is representing the difference will be treated accordingly as an asset or a liability. Now in this case, we said, okay, there is a difference of 2 naira, which represents goods in transit. So we've taken the necessary journal to ensure that the current accounts cancel against each other. But here, since it's a product, we say it's possible that the holding company has transferred at the cost plus, that's at the profit. We must eliminate the profit as usual, just like what we do in unrealized profit on stock. So once we do that, we now adjust, raise our necessary journals as usual, for unrealized profit. So in this case, now you have goods in transit for 2 naira. So you must also adjust for any profit element in this 2 naira, okay, before you now consolidate. So at that level, you can now raise your necessary ledgers and then balance up and then consolidate. Okay, so I believe that you already understand how to prepare your T accounts. So I'll just go straight to the consolidated schedule. Okay, let's quickly take this question so you understand what we're talking about here. So we have the following represent the balance sheet of Kings Limited and Queens Limited as an event 2018. So we have Kings and Queens, assets, land and building, furniture, equipment, debtors, investment in Queens, inventory, cash at bank, current account Queens. Okay, so we have it there, liability share capital reserve, current account Kings. Okay, now they said Kings Limited acquired 9% shares in Queens Limited on the respective time when its reserve was 1150. And said the inventory of Queens Limited includes inventory worth 3 million purchased from Queens Limited. It is the policy of Kings Limited to sell approximately 25%. That's on their life of inventory. Then say Kings Limited transferred the land valued at 15 million to Queens Limited. The cost of that land to Kings was 13,500,000. Okay. Okay. Then current account difference represent the set of technical tools sent to Queens Limited. Then we say the general policy for tools is 20%. So you can see there that there's a difference in the current account there. Okay, Queens is holding 40 million against Kings. Kings is holding 45 million against what? Queens. So the difference there is 5 million. So that 5 million represents what? Technical tools sent to Queens Limited. Okay, let's proceed there. So what do we have now? So we have consolidated what? Schedule. Okay, let's go this way. This is cost of what? Control. That's Kings in Queens, 90%. And we have this. Then we have minority interests. That's 10%. And this. We now have a consolidated P&L. Okay. So what say? Say what? Share capital. Points. What do we have? What's the share capital there? 100 million. That's 100,000, right? 90% here is 90,000. Here we have 10,000. Okay. Now let's go reserve. Coins. What's the reserve? We cannot say yet because there are adjustments that will affect the reserve. So what do we have? First one, they said the inventory of Queen that includes 3 million worth purchased from Kings. It is the policy of Kings to sell at profit of 25%. So that means there's an unrealized profit there. So we go. We have what? Cost plus profit equal to selling price, right? So our cost will be plus 0. How many percent is it? 25. Is equal to what the selling price here is 3 million, that's 3,000, right? Good. So that means this is 1C plus 0.25C. Okay? So that will be 1.25C equal to 3,000. So C will be 3,000 over 1.25. So what is C? If you divide equal to 3,000 divided by 1.25. That's 2,400. C is 2,400 naira. So that means our profit will be 3,000 minus 2,400. So that will be what? 600 naira, 600,000. So based on that, we are going to raise our journal now. So we'll say what? Credit what? Inventory with how much? 600. Then debit what? Reserve with how much? 600. That is for unrealized profit on inventory. Let us say Kings Limited transferred the land valued at what? 15 million to Queens. The cost of land is what? 13,500,000. Okay, so we have land and building. So there's a selling price of what? 15,000,000, cost price of 13,500,000. So if you take this out, 0, 0, 10 minus 5 is 5, 4 minus 3 is 1. So we have 1,000, like 1,500,000. Okay, so this is what? Unrealized profit on the what? Land and building. Okay, so what's our journal? Okay, that means we are going to what now? Credit land and building, and then debit what now? debit reserve, right? Because land and building has been captured by the subsidiary as 15 instead of what 13.5. So we have to what bring it down there. So that means we have to what debit reserve and credit land and building. But remember, don't forget that ordinarily, if it were to be an asset that has what depreciable, behavior, we're going to calculate what over depreciation. But land and building does not depreciate. So in this case, we only adjust for the what unrealized profit on the what the disposal of land and what building. So the next one there. What did they say there? Say the current account difference represents a set of technical tools sent to Queens Limited. So what's the current account difference there? The current account difference Queens is holding 40 million against Kings. King is holding 45 against. So in King's book, Queen is a debtor. In King's book, Queens is a debtor. In Queen's book, Kings is a creditor. So if Kings is holding 45 against Queen, Queen should be holding 45 against King. But now, Kings is holding 45, Queens is holding what? 40. So the difference is what? 5. So we have to adjust to ensure that they are holding the same value against themselves. So we have what now? Current account of Kings in the book of what? Queen. So we'll say what? Current what account, right? Kings, right? Okay. So it has what? A credit balance of what? 40 million instead of 45. So instead of it to be 45, it is 40. So we have to adjust to make it agree with what Kings is holding. Okay? So how do we adjust? Because it's a credit balance. It ought to be 45 million credit balance, but it's 40 million we're saying. So but we have to make it 45. So what do? We credit it. So we credit what? Current what? Account Kings. Okay, with what? 5,000, okay? And then debit what? But they said that what? That money represents what? Represents tools sent to Queens. So that means Kings has sent some tools to Queens. Okay? They have sent some what? Tools to what? Queens. Alright? Now that tool that has been sent to what? Queens, they said what? It is what? Still in transit. Okay? It is still in what? Transit. So that means that we're going to say tools in what? Transit. Okay? Now hear what they are saying. They are saying that what? Depreciation policy for the tools is 20%, and that what? The Kings has sold at what? At 20% what? Profit. You see? So that means there's an unrealized profit in this thing as well. Okay? So what do? So it means that we're going to have C plus P to be equal to what? 5,000. So that would be, it says 20%. That would be 1.2 equal to 1.2C. Okay, is equal to what? 5,000. So that means C will be 5,000 divided by 1.2. So what do you have? 5,000 divided by 1.2. That's 4167. Okay? It's 4166, but let's say 41617. That's the cost price, right? So what will now be the profit? Profit will be what? 5,000 minus 4167. So what do you have? That'll be what? 833. Okay? This is 833. So there's an unrealized profit on the what? Equipment. So what do we do? So what do we do? Of course, you know that the unrealized profit would have to, okay, reduce the what? The tool item. So we say credit what? Tool in transit, right? 833, and then debit what? Reserve 833. Okay. Now there's over depreciation. Okay. Ordinarily, remember, if we adjust for unrealized profit on transfer of fixed asset, we adjust for over depreciation. But in this case, the tool is still in transit. Okay. And that means that it has not yet been received by the subsidiary. Okay? So we are just trying to adjust for the difference in the current account. That is why there's a difference in the current account, because there is what? A tool that is in transit, which the holding company has held against the subsidiary. But the subsidiary has not yet received the tool for them to what? Now enter the necessary entry against the holding company. So it means that the tool is yet to arrive. So there's no usage on the tool at the point of what? Reporting. So fine, we'll adjust for the unrealized profit, since the holding company cannot be selling to itself. Okay, but that depreciation element is not yet enforced, because the tool is yet to arrive and there's no usage for productivity. In fact, it has not been captured into the book, so to say. Okay, not talk of what? Usage for depreciation. So at the time we are reporting or we are consolidating, the tool is here to arrive. So it's here to be captured. So we are adjusting for it, since we know it's in transit, that it will eventually come. So that we can what? Eliminate that difference between the current account. Okay, that's why we are capturing. But then we must also eliminate the unrealized profit, because we cannot be selling to ourselves as a holding company. But over depreciation will not come in here now, because usage has not yet been captured. Okay, so we'll just stop at what? We'll stop at the point of unrealized profit on the tools in transit. We will not adjust for over depreciation. Okay, so that's it. Any other one there? So that's it. So let's open our journals, our respective journals now. So what is the first journal there? We have inventory, which is like stock, right? So we have balance brought forward. What is the balance brought forward for the inventory there? We have 9,000. Coins inventory, 9,000. So we're crediting with 600 here. So we have unrealized profit, 600. So the carry down now the what? 8,400. So we have 9,000. We have 9,000. So we have a new balance here to be 8,400. So what's the next one? Land and building. So we have land and building. And what is it from Queen's perspective there? 15 million. That's balance brought down. We have 50. So what are we adjusting for there? Unrealized profit 1.5. So unrealized profit we have 1 base. So what will be the carry down now? I think that will be 48,500. That's the difference. 00090. Yeah. So we have 50,000 here. So there's a new balance, 48,500. Okay. So what's the next one we have? We have tools in transit. Do we have tools in transit? So what do we have here? Current accounts. Okay, 5,000. Then we now have what unrealized profit element there. That's what 833, right? So unrealized profit there will be 833. So we have a carry down of 4167. So the new balance here of 4167. So the tools in transit is 4167 based on costs. Okay, so we've done inventory, we've done land and building, we've done current accounts. Okay, that's tools in transit. The next one now, let's have our what? Reserve. So what are reserve? Credit, debit, balance brought forward. The reserve is, what do you have there? 21,150. 21,150. Okay, so here your debiting reserve, inventory, unrealized profit on inventory 600. Here your debiting reserve, right? Unrealized profit. This is for inventory. This is for land and building. Okay, right? So we have 1,500. Okay. So what's the next one here? Unrealized profit on tools in transit. Tools in transit. What do we have? 833. Okay, so what's the new balance? 21,150 minus 600 minus 1,500 minus 833. What do we have? 18,217. So we have 18,217. So the new balance is 18,217. So our reserve here is 18,217. So we have 18,217 into pre and what? Post. What's the pre? The pre there, 1150. We have 1150. Minority interest is 10%. What will be the posts? 18,217. 18,217 minus 1150. 17,067. 17,067. So what do we have there? 0.9 times this, 0.9 times this, then we have 0.1 times, so it's 0.1, okay, times this, that's 18,217. Okay, so what we're doing here is trying to get, the various aspects of the reserve. So the pre here is 0.9 times 1150. Minority interest 0.10, that's the percentage of minority times the reserve. Then we have the post here, which is this minus this to give you the 0.9 of this. Okay, so let's go. So here, let's take this up a bit. Space. So we have reserve for coins 18,217. Okay, so 0.9 times 1150. 0.9 times 1150. 1037. So we have it here. 1037, right? What do I have? So 1035. So we have minority interest there. 0.1 times 18,217. 1822. 1822. Okay. Right. So that means that okay. So what do we now have here? 0.9 times, what's the post there? 17,067. 17,067. What do we have? 15,360. 15,360. If you add this and this, you give you this. So let's try. Okay. 15,360 plus 1822 plus 1035. 18,217. So we can proceed here. This is 53019. Okay. This is 22811. Right? Yeah. So this is your net asset what acquired. So what's your cost of investment now? Cost of investment here is saying that Kings invested in Queens for 85 million. So this is 85. I think we're having some difference here now. So you can see this is 530. 11 minus 5, I think it's 6. Let's check. 91035. 91035 minus 85. 6035. So this is the goodwill. Now you have to check, is it a debit balance goodwill or a credit balance goodwill? So let's check. We have investment. What do we have here? 85,000, right? So net asset acquired here is 91035. So we're going to have goodwill here 6035. So if we test this, our goodwill, okay, investment here, that's it. It's a credit balance goodwill. Remember, for balance sheet, which is asset and liabilities, assets and debit, liabilities and what credit. So this is taking the liability side. So it's going to be part of reserve. I've explained that already. It's going to be part of reserve. So we'll just take it off. So we'll say 6035. So this becomes what? New. Then we'll bring it here. 6035. It's going to be part of reserve. Okay. So what's the next thing you have here now? Okay, you have 11822. This is your minority interests. So this is your what? Minority interest. Okay. So now let's bring our what? King's reserve from the question. What are King's reserve? Our King's reserve is 104,500. 104,500. So when you add up, you have 15,360. 15,360 plus 6035 plus 104,500. 125895. 125895. So this is your consolidated P&L, or you can just say consolidated reserve. This. So after this, let's show our statement of financial position. Straight up. So see what? Kings and its what? Subsidiaries. see what statement of what financial position as at 31st December 2018. So we have our notes. Assets, we say non-current. Let's call that note 1. So let's put that here. Note 1. What are non-current assets now? We have land and building. Land and building. So for holding company is 60,000. Then there's a new one for subsidiary which is 48,500. So it'll be 60,000 plus 48,500. So what do we have? 60,000 plus 48,500. 108,500. 108,500. What's the next one there? Furniture and fittings. What do we have? Furniture and fittings there. 40,30. That's what? 70,000. Equipment. Is there anything on equipment? Is there anything on equipment? Nothing on equipment. Equipment there is what? 7 plus 4,000. That's 11,000. Okay? Any other thing there? So we have the tools in transit. Tools in transit. What do you have there? 4167. So what's the total? We have 108,500 plus 70,000 plus 11,000 plus 4167. 193667. 193667. 193667. So we have current. Note 2. Where do we put that? Okay. So let's say note 2 here. Okay. Note 2. So what are they? Debtors. Debtors is what? 20,000 plus 37,650. 57,650. 57,650. What's the next one? Inventory. That's 13,000 plus what's the new inventory here? 84. So 13,000 plus 84. 21,400. What's the next item? Cash at bank. 34,500 plus 30,500, 65,000. So let's call this bank 65,000. So what do we have? 57,650 plus 21,400 plus 65,000. 144050. 144050. So we have 144050. So that's it for current and non-current. So this time around there's no goodwill, so let's add up here. So we have 193667, 193667 plus 144050, 33717, 33717, right? 33717. So this is your total assets. Then the next one we have the liabilities now. So what's first thing there? Let's say our reserve. What's our reserve? 125895. What's our share capital? Our share capital is 200,000. And we have our minority interest. What do we have there? 11,822. Okay? The current account, by virtue of this journal, will cancel out, so it will not appear again. That's the essence of the current account. It should be equal from both perspectives, so you can cancel out, equal and opposite. Okay? So that's it. So what do we have? 125895 plus 200,000 plus 11,822, 337717. So this is your total liabilities. Okay. So what we've done here is to, prepare consolidated balance sheet. Okay. By taking into consideration how to adjust for what? Current accounts in between what? The group, or within the group, or intra-group current account. So the idea is that they're supposed to be equal and opposite. So if I'm having 450 against you, you should have 450 against me as holding and subsidiary. But when it's not equal, there must be a difference. That difference must be what? Accounted for properly and adjusted for before we would consolidate. That's what we've done here. Okay. Then we also tested some other things that we've done from the inception. So take your time, go through it. If you have questions, you can read on the numbers displayed and let me find the right answers. And don't forget, you can support us by printing account numbers displayed or sponsor copies of my textbook for free distribution. Thank you, and then see you next class.